get started, if you could, fill out the Finance Club thing for me, please, form, give that back to me. If you don't have it, there's an extra copy there. If anybody wants to take a look at the global memos, take a look at that in format, you can do that. If you want to look at the stock and the bond market fact sheets, these are pretty good too. Just going to be doing some of those, and that might dovetail nicely right into the your stock markets that you're following. Did I hand out the SIE stuff? Yeah. Thank you. What you may want to do too, I'm going to go over the portfolio construction strategy for your passive strategy that you're going to be working on Monday. So you may want to talk about that over the weekend. If you want, you can get some ideas, how to construct your portfolio from iShares or VanEck or Vanguard or Fidelity or Schwab, who have built international equity portfolios before. So here's some examples of the fact sheets if you want to take a look at those. If you want to take a look at some of the examples of the bank valuations, here's an example of the Deutsche Bank and some of the others. So I have those here if you want to take a look at those. I think I'll end it there. So I'll post the video from the course today and then send that out to you. Is everybody receiving those? Okay, and I'm going to put the videos in the log too, so you can go to the website and it'll do the chronicle, of the class, with the videos and everything, so you can go back and use those as references. When we're looking at the market updates now, we'll see how much time we have today, but the strategy will be, you'll give us an update on your stock market. We should be tracking Brent oil prices, not West Texas Intermediate. Brent is the Saudi, it's the European quoted price. Obviously they're correlated, but I want you to start thinking globally. Gold, look at gold prices, but if you can find gold prices that are being quoted on a global basis or out of a certain region, that's probably going to be more interesting. And I'm really interested in gold reserves, that are being held by treasuries or central banks, because those gold reserves, do have an effect not only on gold prices but also currency values. And then bonds and bond yields. I want you to start thinking about the quiz. The quiz, what you're going to do on the quiz is you're going to basically do some research, within the course, and you're going to find the interest rates for different countries, and you're going to trace out the yield curves today, 1, 3, maybe 5 years ago, so you can see the dynamics of the yield curve, and then you're going to calculate the spreads between the U.S. yield curve and the international yield curves, because that has a major effect on currency values also. So I would start looking at the yield curve for the U.S. and comparing it to Japan, Germany, and the EU. And those three countries, or those three areas right now, still have negative interest rates on the short end of the term structure. And then our yield curve is a lot higher than theirs. So if we're offering higher interest rates on a global basis, then there's going to be more capital flows coming into the United States, which is going to prop up the dollar and push down foreign exchange valuations. So the interest rates and stock market returns and real estate returns in one country compared to other countries has a major effect on capital flows and foreign direct investment in those countries. And then start looking at exchange rates. I know that the dollar to the pound, or the pound, has depreciated significantly over the last couple months because of the Brexit. Theresa May got shot down the other day, and being able to move forward, on to go negotiate the Brexit with the EU. That's had a major effect on the pound, and I don't know what they're going to do. Looks like they may actually be forced into a hard Brexit, which will be an amazing event, because nothing like that has ever really happened before in post-World War II history. So we're going to do the chapters today. Are you guys ready to go? Okay, yeah. Awesome. And then as I move along in the course, particularly next week, I'll be going over the pre-test and the quiz and the homeworks and, you know, the memo reviews. I'll just, you know, continue to do that. Some of the projects that I have slated for us, it's a pretty aggressive, you know, research strategy that I've laid out. Let's just see, you know, how much of these projects I can, you know, we can do together, so that when you walk out of here, you have a really solid portfolio, you know, of work that you can show, you know, any prospective employer. So the first product that we're going to do is the passive portfolio. We may do the active, but definitely the passive portfolio, and I'll go over the criteria in which you're going to need to discuss with your teammates to come up with the portfolio strategy, to then construct the strategy, and then to be able to build the product and sell the product to the investment committee. And if the investment committee approves of your product, then we're going to commercialize it. We're going to distribute it through our distribution channels. The stock exchange and market tracking, that's what you're doing right now. The global bank valuation, we'll do that. That's a nice product too. Global fintech product innovation and development. That's only like a 5-slide, you know, product. You know, it's going to be a nice. You're going to put it in a nice pitch book like this, but it should be a pretty straightforward, you know, 5-slide, you know, mini deck where you're pitching the investment committee of a fintech product that you've embedded. I want you to start thinking in global product innovation, you know, global product design and distribution. I'd like you to also do a mini research report. You know, maybe get 3 or 5 articles. I've already given you the article intake form. You know, fill that out and then roll it up into maybe a 3 or a 5-page paper. Again, that you can show, you know, a potential employer that you know how to write and do a research piece. And then I'm going to probably be talking to the Chicago Mercantile Exchange next week, and I'll probably have them do a demonstration, and let's see if we can use their platform to trade some global derivative contracts and see how we do. So I'm going to explore that. I've never done that before, so we'll see how that turns out. So that's kind of the research agenda, you know, that I'm looking at. The institutions that have a lot of the research, and these are the global institutions that you need to be familiar with and that are extremely important because they have a lot of research that you might be able to take advantage of for your research and everything that you're doing. One is the United Nations. Obviously, the World Bank does a lot of research and provides a lot of data. The Bank for International Settlements, International Monetary Fund, Organization for Economic Cooperation and Development. I believe that they provide the balance of payments, information and data. Obviously, the central banks. These are the major central banks. And actually, the central banks in the economies up until the financial crisis, they were somewhat coordinated, you know, in their monetary policy prior to the financial crisis. But there were, you know, countries were doing different types of monetary policy, and they were growing at different rates, and their cycles were different, so you could really get global diversification with your equity and your fixed income portfolios. But after the financial crisis, they really all kind of colluded together, and they were all coordinated together, really following the Federal Reserve. So it's a different institutional policy regime now post-financial crisis. So the major central banks are the European Central Bank, or the ECB, Bank of Japan, Bank of England, Bank of China, and the Federal Reserve Bank. So those are the major banks. And again, a lot of these banks printed trillions and trillions and trillions of dollars, and most of the money that they printed went in to buy government sovereign bonds to prop up bond prices and drive interest rates to 0 or negative to try to stimulate the economy. That experiment had never been done before, and there's major debate right now, politically and philosophically, around the central banks and their credibility and their independence, because I think we're all coming to the conclusion now that basically the credibility and the independence of these central banks on a global basis have lost their credibility and have lost their independence, and now because they own a significant portion of the government's debt. They're now an arm of the Treasury or an arm of the government. So that's really scary, actually. So that's just something you need to think about. And then the World Trade Organization obviously sets, they're actively involved in the whole tariffs debate between China and the United States. So again, they kind of oversee the whole global institutional system of free trade, if you believe in that, which we do. And then just data sources. IBIZ is really good. I've been talking to Sarah Vitale, in the library. She'll walk you through all the international sources of data and information. Obviously, S&P, Net Advantage. You can get all the ETFs that are traded, on the U.S. exchanges. They're basically global exchange-traded funds that are traded on the American exchanges. Okay, and I want you to do that. I don't want you, when you're constructing your portfolio, using stocks, foreign stocks that are traded on the foreign exchange, because you're going to have to deal with currency conversions. So just when you're constructing the portfolio, just pick the foreign countries whose ADRs are traded either on the NASDAQ or the New York Stock Exchange. Okay, it'll just make everything so much easier. Obviously, Value Line, Mergent, Morningstar, Bloomberg. The Economist is a great magazine. You should have access to that either through me, through the syllabus, or through the library. The Financial Times is awesome. It's my favorite newspaper. You have access to the Wall Street Journal now through the library. Again, Sarah can set you up on that. There's another data provider, Data Stream, and again, the CME is just like the New York Stock Exchange or the stock exchanges that will give you some data. I'm going to stop talking here pretty soon until my voice runs out. But then I'm going to turn it over to you guys, and you get to talk, okay? So let's talk about the global static passive index portfolio. Let's talk about what you're going to be talking about amongst your team members. And you can even talk amongst other students too, have the debate and try to figure out what product you're going to develop, okay? And you have to make a decision, okay, on what you're building. So the first thing is, what is your portfolio strategy and what's your portfolio style, okay? You can get ideas of portfolio strategies and portfolio styles by looking at exchange-traded funds or mutual funds. I prefer exchange-traded funds. Of international portfolios or global portfolios that are currently being traded on the exchanges. iShares, BlackRock has a whole list of country funds, international funds, global funds. I try to pick the funds that don't have US companies in it, just pick the funds that just have purely foreign companies within the portfolio. So that'll give you kind of an idea. If you go look at those, how you're going to be putting yours together. But there's a matrix of decisions that you're going to have to make. Are you going to be investing in large cap, mid cap, or small cap stocks? Or a blend? What's the allocation? 100% large cap, 50% large cap, 25% mid cap, 25% small cap. What are you doing? What's the allocation amongst market cap for these companies? Then you're going to have to pick, and you're going to have to give me the allocations by country and region. Okay? So I'm going to have X percentage of my portfolio by these X countries. These are the percentages, and these are the companies within those countries that we're going to be allocating to. Okay? So what I'm trying to get you to start training you now is how do you construct these portfolios? How do you build these portfolios? So you got to give you the allocations. Are you going to be picking established markets, established countries, or are you going to be putting together an emerging market portfolio, or a blend? So is it established, purely emerging market, or are you going to do a blend? You got to figure that out. Okay. The other is the industries and the sectors within the portfolio. How are you allocating across different industries or industrial sectors? What's your strategy? Is it going to be more defensive? So you're going to be in consumer products, utilities, or are you going to be more risky and go for tech companies and other types of companies that are more volatile, more risky, but also you would expect a higher rate of return? So you got to give me a sector allocation too. Is the strategy aggressive or is it defensive? Are you looking for high beta stocks or are you looking for low beta stocks? Do you anticipate a recession, so you're constructing a defensive strategy to sell into the marketplace in anticipation of a recession, or are you selling a cyclical strategy where you're really taking risk and you want higher betas, you know, where the where the returns in the stocks are going to move more than the overall market. So you got to be thinking about that. And then you got to tell me, is this a high, moderate low, low risk portfolio? What's the risk tolerance of the investors that are buying this product? So you got to give me the risk level. You also got to give me the expected portfolio returns. That's one of the most important things that people want. Are you going to give me a high return, expected return, a moderate high return, or a moderate return? Obviously, I don't want a portfolio that gives me low returns unless the volatility is extremely low. I'll take low returns, but my standard deviation's got to be like 0, or my beta's got to be negative or 0, something weird like that. But you got to give me the expected returns. And obviously we know that the minimum expected return on these portfolios got to be between 8 and 10%, so that the money in the portfolio, my portfolio is going to double in less than 10 years based on the rule of 72. But you got to give me a range, okay? And there's some presentations up there of these presentations that were made last year and in my investments class that basically lays out, you know, the PowerPoint presentation, how you can presenting this information in the PowerPoint presentation to the investment committee to get approval to basically design and produce and distribute the product. You have to be able to calculate the average portfolio beta. Okay, within the spreadsheet and within the target portfolio worksheet, it has the calculation to be able to do the weighted beta. You just put in the betas and it calculates the weighted average for you. Ideally, if you had more time, which you might, you can get a time series of the stock prices and maybe calculate the returns year over year, quarter to quarter, and calculate the standard deviation. So you can take the returns and divide it by the standard deviation, or take the returns minus the risk-free rate, divided by the standard deviation, and be able to calculate the Sharpe ratio, or the Jensen, or the Trainer ratios. These are the portfolio ratios that you would use to measure the return to risk ratios, the return to risk, the unit of return per unit of risk for the portfolios. So, but I need at least the average beta calculation. The average holding period, you got to tell me. The average holding period for a stock investor is basically 5 to 7 years, but 7 years is really the average. So if you're a stock investor, on average, you hold the stocks for about 7 years. But if you're getting me higher returns and there's higher volatility, then you're targeting a different type of investor group that's going to want to get a higher return. They're willing to take the risk, but their holding period is only 3 years until they sector rotate or rotate out of the portfolio. Your target investors, who are you targeting with this product? Are you targeting mainly institutional investors, endowments, pension plans, corporate pension plans? Are you targeting family offices that are basically made up of ultra high net worth or accredited investors? Are you targeting ultra high net worth and accredited investors? Or are you targeting retail investors to put together an exchange traded fund or a mutual fund? Or are you advising your clients? Mainly the ultra high net worth, the accredited investors, the family office and the institutional investors, and you're not building a retail product for mass distribution, you're basically building a single account strategy. So I'm going to go work with CalPERS. They're going to give me $5 billion. We're going to build this product, and we're going to advise them and actually purchase the shares and put them in a single account and manage the portfolio as a single account. We can do that too. So you got to be thinking about, you know, who your target investors are in this product. The actual products are going to be either single accounts, exchange traded funds, mutual funds, and actually if you do a good job on this portfolio, you can create indices or an index out of it and we can go to the Chicago Mercantile Exchange or the Chicago Board of Trade and ask them to design some standardized futures and option contracts for us. We can also build the indexes, and then Goldman Sachs and Merrill Lynch and those guys can basically write and buy forward contracts based on our indices, and we'll make some money off of publishing the indices. Okay, so this portfolio could also be an index, and we can make some money off the index through the over-the-counter market as the forward contracts are written and bought based off of the indices that we produced based on our portfolio strategy. Fees, okay, we got to make money off this at the end of the day. So the fee structures, usually the fees on this type of product, depending on if it's a large cap, stable, moderate return, lower risk type portfolio, the fees are going to be compressed to around 1% or 100 basis points of assets under management, or AUM. Okay, we may be, depending on your style and your strategy, if it's aggressive, you may be able to charge, maybe on an actively traded portfolio, you could probably charge up to 250 basis points or 2.5% on AUM. We're not going that high. I just say you pick a range between 1%, maybe 1.25% or 1.5% of assets under management, to be able to calculate what your gross fee revenue is going to be on this thing. You can get some pretty compelling numbers pretty quickly on these things. So your target AUM, and again, depending on the product that you design, is going to determine the rate in which you're going to be able to raise the capital and deploy the capital or build the portfolio size. Okay, so usually we want at least a minimum of $1 billion. I want at least a minimum of $2 billion. So $2 billion to $4 billion, okay, over basically a 3 to 5 year period is really our target. So once we build this thing, then we'll go into the market, we'll market it, we'll shoot it out to the RIA community and the institutional investors, and we'll try to get as much assets under management as we can. So I'm shooting for $2 to $4 billion within 3 to 5 years. This is all going to be in your PowerPoint presentation, but you're going to have to figure out from these things exactly what you're selling, not only the investment committee, but also selling your clients. So gross fee revenue, this is the funnest part right here. Okay, Billy, this is the best part right here. Okay, so basically, if I can raise, if I can invest $2 to $4 billion at a 1% AUM fee, we're going to generate basically $20 to $40 million per year. Hello? Does everybody hear me? 20 to $40 million per year. Okay? This is the reality of the situation. This is what these people do. Okay? This is how they do it. This is how compelling these economics are. And it doesn't take a lot of people to basically build these things these days. The data's gotten a lot cheaper. The computers have gotten faster. They can build these things a lot quicker, and we can manage them. I can probably manage one of these portfolios with me as the portfolio manager with maybe 3 analysts. So I'm looking at maybe 5 people, okay, to run a $2 or $4 billion portfolio. So the costs now of running these things is extremely low. So all of that revenue basically flows right down to the bottom line and right into the partners' pockets and right into your pockets as a portfolio manager and as an analyst on these things. So if I charge a point, I can get 20 to 40 million. If I charge a point and a half, we're bringing in 30 to 60 million dollars a year. And then what I would do is I would net these out against the expenses, the data costs, and the space, and then once I get the net fees, then I'm probably going to have to give 50% of our revenue to Goldman Sachs, because we sit on their platform, and then I'm going to pay all of us our salaries, and then once we get the salaries and all that stuff, then I start dishing out the bonuses, okay, based on the performance of the portfolio. Okay? Is everybody clear on what it is you need to negotiate, what you need to be able to do? Okay, and then in the, I don't know if I'll have time to bring up the Excel spreadsheet, but the Excel spreadsheet is pretty straightforward. If you go into the master target spreadsheet, the worksheet, and I think, I know you guys, you all three, you have, and you know how to do it, Mason also knows how to do it. You have it, you guys have it in the back. I would work with them, the people who have already taken my investments class, so they can show you how to basically do it very quickly. It's pretty simple. The first worksheet, the target worksheet, you just put in the current price for the 25 stocks that you've selected. You put in revenue or market cap to be the weighting, scaling factor, and then you just go 1 year, 3 year, 5 year, 10 year, and you just put in the prices. And it automatically calculates the returns for you, okay? And then in a month from now, we'll update the pricing of the portfolio. We'll do it again in 2 months from now, 3 months from now, so we will have back tested and forward tested your portfolio. And then that'll be put into your final presentation at the end of the semester, so we can test your, see how your portfolio did against the global benchmark. We're gonna use the MSCI Global. You may wanna write that down. I'll show you how to calculate the average annual rates of return for that ETF or that index, because if I can compare the return on your portfolios compared to the global benchmark, we can calculate the alpha, okay? That's all we really care about. What is the return that you're providing? As long as it's above 8%, we're in. 2, if you can provide us alpha between maybe 100 to maybe 600 basis points is what I've been seeing over the last couple of years doing this experiment. If you can get 100 basis points above the global benchmark, capital's going to start flowing in, and we'll be able to reach our AUM targets probably within the 3-year period instead of the 5-year period. So the more alpha you can create through your stock picking capabilities, the faster the money will flow into the fund. Okay, that's it. So who's ready to go first?
I have a question. Awesome. Do we have to all do different stock exchanges?
No, you can do the same ones if you want to, but I would try to do different ones if you can, just to make it, more interesting. But it really is up to you. If you're stuck on Asia, then obviously Tokyo and Shanghai, or in Singapore are great exchanges. If you want to get into the Southeast Asian, economies, then you want to be looking at, Thailand and Vietnam and, Indonesian exchanges. If you want to do Eastern Europe, then you look at Poland, and that would probably be a good Eastern Europe. You want to do some kind of messed up countries like Venezuela or Russia or something like that. Go ahead and do it. It should be up to you to decide what you want to do. Okay. All right. So you guys ready? How much time do we have? 30 minutes? 20 minutes. Yeah, just do the best you can. Okay. Don't stress out on time, because we could always push it to Monday or. One. And thanks for filling these out. I appreciate that. And then you guys need to come up with a portfolio name, not Dr. Seuss's BizAd 135 static portfolio. It's got to be something that you can actually market, to someplace. Right? Just make it interesting. Same thing with your products.
Are you cool with Bank of Shanghai? Yeah, no. Bank of Shanghai.
Yeah, are you going to do Bank of China? Be careful if you do Chinese banks, because a lot of them aren't publicly traded on exchanges. Only manufactured financial
Okay.
Billy, if you think you can value the Bank of China, it's publicly traded. Good luck. I don't think it's going to work. Aren't you going overseas, Billy?
No.
San Diego. San Diego? There's no bank.
No.
Didn't you go to Ireland?
Last year.
Oh, but you're going to do the bank and the exchange in Ireland? You're doing London. So are you going to do Barclays? Barclays? The bank? You should do Barclays. If you're doing the London exchange, do Barclays, and then be our London, UK expert.
See Barclays.
Yeah, that's good.
Okay, ready?
Yes, thank you.
Okay, so we covered chapter 1. Just a little bit of what we're going to be talking about. What is special about international finance, goals for international financial management, globalization in the world's economy, multinational corporations,
the screen?
Yeah.
Thank you.
So, what is special about international finance, just from like reading the book, as of 2016, the U.S. has invested $154 billion in foreign securities, and other countries have invested $276 billion in the U.S. So it's something that obviously affects us a lot, and we should study it. There we go. Okay. So for the foreign exchange risk, major currencies including the dollar, yen, pound, euro fluctuate continuously in an unpredictable manner, and this is different because starting in 1970, fixed exchange rates were abandoned. So then now there's this fluctuation. So if we use the example of the yen, $1 equals 100 yen, but that value could change over time. If the yen were to depreciate to $1 to being 120 yen, you would have lost money if you invested in an international stock. And that's just the math at the bottom of what I just said. And so this is just a graph of the same thing, just to show how how it has fluctuated over time. It's changed validity since 1973. The uncertainty will have an influence on economic factors, including consumption, production, and investment, which we're going to talk about in this PowerPoint.
Can I make a note real quick? If you do this for other currencies, what you're going to find out is that this is a managed float system. So the Japanese yen basically is managed, by their treasury and their monetary authority. So you can see the band in which they're managing the float within the currency. So this is a managed float system. So they're managing really between plus and minus 5% is how they regulate it. So they're going to depreciate the currency to spur exports. They're going to appreciate the currency to mitigate exports. So they're managing the float to basically manage the economy. And they're export oriented too. So they're really focused on currency exchange rates because they're an export oriented economy. 70% of their GDP comes from exports, where here 70% of GDP comes from domestic consumption. So it's different strategies for different countries. Thank you.
So the first factor, political risk, ranges from unexpected changes in tax rules to expropriation of assets held by foreigners. So an example that the booklet used was a sovereign country can change the rules, and it affects different parties, different nations. In 1992, Enron Development Corporation signed a contract to build India's largest power plant, and after spending approximately $30 million on the project, it was canceled. So things like that have a huge impact on not just that country, but on all countries. And for market imperfections, the various impediments in preventing markets from functioning perfectly play a huge role in motivating multinational companies to locate projects overseas. So if you look at Honda, for example, which is a Japanese car company, they have factories in Ohio, and they established that to avoid trade barriers. So you'll see a lot of companies will do that. They'll be based in one area, but they'll have factories in different areas to kind of make up for these market imperfections. And another example of this is Nestle, who used to sell two different types of shares. So they would sell bearer shares and registered shares, and the bearer shares would only be available to people buying stocks internationally, and then the regular shares, registered shares, were only for people in Switzerland. And so one type of stock was a lot more expensive. And so then in 1988, Nestle lifted these restrictions imposed on foreigners, allowing them to purchase both types of stocks. And what that did was, you can see from here, the bearer stocks were a lot more expensive, and then the registered stock prices were a lot less expensive. And once people were able to purchase both, the stock prices changed drastically. You can see they were 2 times more expensive, and then that obviously changed. So a major transfer of wealth between foreign and domestic see just basically the wealth between foreign and domestic stockholders, like I said, has changed, and this has gone over more in chapter 17, and it says that in the book, this specific case. And then expanded opportunity set. Basically, firms can locate production in any country or region to maximize performance and profit in a market where the cost of capital is the lowest. That kind of goes back to the Honda example. Also true for individuals. If an individual diversifies their portfolio internationally, they'll have a lower risk and a higher return rate when compared to if they were just to do a domestic portfolio. And so when we create our portfolios in this class, we'll kind of see the same thing if we compare them to the ones that some of us created in the investments class. Because stock returns tend to convey less across co-vary less across domestic market than international. And so some of the goals for international financial management that were stated in the text was to provide an understanding of the fundamentals, concepts, and tools needed to be global managers. And so then it kind of talks about what the main goals should be, and one of them being maximization of shareholder wealth. So all decisions are made in the system basically to make the owners the most wealthy, and that seems to be the goal in certain countries like Australia, Canada, UK, US. How can we maximize their wealth? But that's not the same in all countries. So in other countries, some of the goals include stakeholders. So for example, in Germany and France, shareholders are viewed as stakeholders, and in Japan, their system is completely different. Many companies form smaller number of interlocking business groups, and basically this rose from the consolidation of family-owned business empires, and while this isn't as big of a thing now, it still is a very different system from what we know. And yeah, it's just basically to increase market share over shareholder wealth. So you can see how priorities are different in different countries based off of their financial goals. And then principal agent conflict. So managers may pursue their own private interests when they are not closely monitored, if no one's preventing them from doing that. So this drove a lot of companies to bankruptcy. Companies like Enron, WorldCom, Global Crossing. So something that's really important is corporate governance, to regulate the relationship between management and shareholders to make sure that the management isn't taking advantage of people just to produce the most amount of wealth. And this is something that is worked on a lot in the US, but as we'll see in later chapters, specifically in chapter 4, it needs work in like Indonesia, Korea, China, Italy, Russia.
So other goals that we were talking about earlier, countries like you mentioned, Indonesia, Korea, and Russia, have a lot more of these problems because they're emerging and transitional economies, so they're not a fully advanced economy like us or maybe some of Western Europe and Japan. And so all these other goals can't be achieved if you're not also maximizing the shareholder wealth. So these are some of the trends. You should probably all be aware of this, or you should change your major. Emergence of globalized financial markets, emergence of the euro as a global currency, Europe's sovereign debt crisis of 2010, trade liberalization, economic integration, privatization, global financial crisis of 2008 to 2009, and we'll go over that now. So the emergence of globalized financial markets, obviously today markets are much more interconnected, and that has a lot to do with technology, with the internet, it makes everything cheaper and faster. And financial innovations, so currency futures and options, multi-currency bonds, cross-border stock listings, international mutual funds, and ETFs. And the emergence of the euro as a global currency. Right, so over 300 million Europeans in 19 countries are using the euro, which is a pretty recent development. Thinking about money historically, to have that much range of using one currency. And the transaction domain of the euros may become larger than the US dollar in the near future, because historically everyone's used the US dollar to compare everything and to do international business, but with the euro becoming stronger and their economy is getting bigger, it might change. Europe's sovereign debt crisis of 2010, so Italy and Greece, but particularly Greece, their economy tanked after 2008, and because so because it's, even though Greece is like a really small part of the Eurozone, because of the system of the Euro, of the European Union and like the Euro, the currency, it like quickly spread throughout the system, and the European Union became partially like responsible for getting them out of their debt. And the Greek drama, as you can see, because of Greece being in the EU, when it wasn't originally part of the EU, but when it joined, essentially it got the credit as if it was Germany, which is like the strongest, biggest economy in Europe. But just because they were in the EU and they were using the euro, people started giving them more credit, and they got into a lot of debt, which they couldn't pay. Trade liberalization and economic integration. So over the past 50 years, basically after World War II, the world has become more international and traded a lot more, which has created, a stronger economy globally, with people being able to get products and services that they might not otherwise have. And and with free trade, with lower regulations, everything just easier, people get what they want. And with comparative advantage, which you learned about in Econ 1. Liberalization of protectionist legislation. So GATT is a multilateral agreement among the member countries that has further reduced barriers to trade. The World Trade Organization has the power to enforce the rules of international trade. And January 1st, 2005, the era of quotas on imported textiles ended. And that's a big deal because, more increased trade means more wealth for everyone, or not everyone, but. NAFTA, the North American Free Trade Agreement, which doesn't exist anymore, right?
Being renegotiated.
Which is not going to exist between us, Canada, and Mexico. So that's not that relevant. NAFTA allowed all three countries to increase their trade, increase their wealth in each individual country, and collectively, and more jobs and more stuff, and higher standard of living. Brexit, which is going to be going on, or going to go through soon, maybe. So they voted to get out of the EU, and it's weakening both the EU and the UK. With so much uncertainty, people aren't going to necessarily invest in, with the difficulties of leaving the EU and changing the fact that you can't just go into England, like as a European, you can't just go into England now and like do business, and you can't get money in and out as easily as it used to be. Or, well, like, people just don't know what it's going to be like, so it's slowing down their economy. And privatization, the selling of state-run enterprises to investors, also known as denationalization, basically going from socialism to more of a free market, and generally considered to be more efficient. But we've all seen how PG&E operates. Chinese privatization, state-owned enterprises have been listed on organized stock exchanges. More than 1,500 companies are on the stock exchanges, but the Chinese government still owns most of the stocks, and basically they control the companies and whatever they want to do. And LSS foreigners are limited to B shares, and the only Chinese citizens can buy A shares. And global financial crisis of 2008-2009. The Great Recession was the most serious synchronized economic downturn since the Great Depression of the 1930s. And it came down to a lot of debt and repackaged securitization. So like subprime mortgages became okay.
So as he was talking about 2008-2009, we hit the recession, but as you can see, when the Dow Jones is trending up, the unemployment rate trends down. And then we hit that peak and dropped, and the unemployment rate hiked because of the Great Recession. So a multinational corporation is a firm that has been incorporated in one country and has production and sales and operations in another country. So there's over 60,000 multinational corporations in the world, and most of the time they obtain raw materials from one nation and capital from another, and they produce goods and labor and capital in the third country, and then it's kind of just a circle that gets them a lot more money than just operating in the U.S. So here are some big examples of multinational corporations like GE, Shell, Toyota, Exxon, BP, Vodafone, Chevron. Just some big examples. You can see they have billions of assets and they have billions of sales in foreign and domestic. And they have thousands of employees, hundreds of thousands of employees. So in summary, it's important to study international finance since we are living in a globalized and integrated world economy. And there's three things that distinguish international finance from domestic finance here in the U.S. Foreign exchange and political risk, market imperfections, and expanded opportunity set. So there's more opportunity but more risk. Everyone here probably knows about comparative advantage, but comparative advantage states that economic well-being is enhanced if countries produce goods and services for which they have a comparative advantage and trade for other goods. So the financial crisis of 2009 could be attributed to excessive borrowing and risk-taking and failure of government regulation, so the big short stuff. Privatization has placed a new demand on international capital markets to finance former state enterprises, and multinational corporations often produce merchandise in one country, obtain capital in another country, and sell the finished product to consumers all over the world. So it's that circle, I guess, of a lot more profit. So we're going to look at like an example of comparative advantage with country A, country B, and they're going to make food and textiles, and we're going to look at comparative advantage. So it exists when one party can produce a good or service at a lower opportunity cost, so one unit, and the opportunity cost of making one additional unit of a good or service can be defined as the value of some other good that you have to give up in order to produce this additional unit. So, for example, if you work as many, so we're going to look at the example. Consider the example where there are two countries, like I said, A and B. They're looking at food and textiles. So initially they don't trade with one another. So here you can see it. So if they don't trade with one another at all, and they put all their resources into making food, they can make 300 million pounds of food. If they put all the resources into making textiles, they can make 180 million pounds of textiles. And then, so they have to like use that. They made a combination of food and textiles, and they can make 200 million pounds of food and 60 million pounds of textiles. Here we're looking at country B. So if country B has to concentrate 100% of their resources in the production of food, then they could produce 900 million pounds of food, as you can see on the graph, and 240 million pounds of textiles. If the countries specialize according to their comparative advantage, then country A should make textiles and trade for food, and country B should grow food and trade for textiles. So that's when trade comes in, because country A has the comparative advantage for food, but country B has the comparative advantage for textiles. So as you can look at the green line, without trade, if both countries made only textiles, their combined production would be 420 million yards of textiles, so 240 plus that 180. But before trade, combined consumption is 800 million pounds of food, which is the 200 plus the 600, and 140 million yards of textiles. So they're going to want to trade because they only have the comparative advantage on textiles or food each. So country A can produce textiles with lower opportunity costs. So let them produce the first. They're going to let them produce the first 180 million yards of textiles. But the combined production possibilities curve with trade is composed of the original curves joined as shown. So you can see that on the red line. And the gains from trade are shown by the increase in consumption available. So country B can only produce food at a lower opportunity cost. So they let B produce the first 900 million pounds of food before they jump into making food. So this is kind of just the gist of trade. So both partners gain from that trade, and we have more material goods on both sides. So freedom is a good thing in and of itself, because they have the freedom to choose imported goods, and producers have the freedom to choose or sell to foreigners based on their competitive advantage. Bang.
So what I'm going to do is, we'll have the Team 2 and Team 3, Team 2 and Team 3 will go on Monday, because we ran out of time. And what I'll do is on Monday, I'll come around, make sure you take a picture of this, and you discuss this with your team members, and then on Monday, Team 2 and 3 will make the presentations, and I'll come around and start working with you, to hear what your strategy is and help you focus your strategy, and then start to show you how to work through the worksheet, to start putting the data in, to start back testing the portfolio. Okay? Nice job.